All right, let's go ahead and get started. Today is Thursday, May 28th. It is also the lovely Marina Parkin's birthday. She seems to have received a flock of flamingos in the overnight. So thank you all for joining us. We also have Jackie Durham and her magnifying glass for you this morning. We're in full effect here at Koontz Group this morning. So we promised we would be coming to you with our PPP updates in terms of the program and the loan forgiveness. And what better thing to do than on your birthday? So without further ado, we'll get to it. As always, our webinars will be recorded and distributed to you following the presentation today. You're welcome to ask questions if you'll use the Q&A box. We will weave those in as we move through the materials. Do not be alarmed if you are confused when we finish. Guidance has dropped and dropped and dropped, and the more guidance we get, the more questions we have. Jackie will continue to lament that throughout the balance of the hour, I'm certain. So let's go ahead and I'll turn it over to you ladies to get started. I'll be monitoring the questions and helping weave everything in. So
thank you, Joanne.
Happy birthday.
Yeah, thanks everybody. This is exactly what I wanted to be doing on my birthday, is talk about PPP loan forgiveness. It's a dream come true. But we didn't want to skip a beat, guys. Things are coming at us faster than we can think, and as we promised, as Joanne mentioned, we promised to keep bringing you updates. There is still more guidance coming from SBA, and at some point what we will do is walk you through the forgiveness application sort of section by section. What we wanted to do today is kind of go through some of the concepts first, as you are starting to put together some of these expenses and starting to track the things that you're spending money on. We wanted to kind of look at the application instruction and talk about some of those concepts and the definitions first, and we'll tackle all of the other stuff in the coming weeks. So what I wanted to start out with first is, when is this loan forgiveness application due? When's the due date? And the answer is, we don't know. So the key here is that you have 8 weeks from the day that you receive your PPP funds, but when do you have to submit the forgiveness application to the bank? As of right now, there's no specific due date as a certain amount of time after your application, or a specific date on the calendar or anything like that. So the key here is really, we have no idea how much time we're going to have after the 8-week period loan ends to pull everything together. So our advice at this point is just to track it as you go, and as you pay your payroll and as you pay all of those expenses in the coming weeks, please keep all of those reports together and keep your records together, so that if you do need to turn this around pretty quick, you'll be able to pull this together. I talked to our banker at Chase and just asked him, and he said that even on the banking side, they haven't given people the deadline yet. They're working on it, but there's, as we get into the meat and potatoes of this later today, there's an alphabet soup of different dates, and one of the dates you will hear from us is going to be June 30th, which is the date when you can make up some of those lost wages or people that may have been furloughed. So I imagine the application is going to be centered somewhere around that date, or at least with that date in mind. But as of right now, we don't necessarily have a date. So if you think you need to submit this application the day after your 8-week period is over, that may or may not be true. So just keep all the records, and as soon as we find out something, we will let you know. But that's the question I'm getting a lot, and I'm sure the bankers are too. So
that's true. And let me just say one thing is, we expect that so far from the start of PPP, when this first dropped that this was even a program, then we had the opening of receipt of applications. From the very minute this became an acronym people are familiar with, the name of this game has been changed. So we saw that those who applied early had some benefits before clarification was issued on certain points. The expectation certainly seems to be amongst the professional community that may go the same way for forgiveness. So there may be an incentive for you to apply for forgiveness early before clarification is issued that may be disadvantageous to you. So like Marina said, stay on it, stay organized, and keep your records as you're going, and you'll have an easier time cobbling it together the moment that you are able to submit. You certainly have to be past your 8 weeks, and then we'll see where that lands as we learn more. But the early bird might end up getting the worm.
Exactly. And there's also, if you look at the instructions for the forgiveness application, there's a litany of documents and supporting documents and backup documents that you have to prepare even if they aren't submitted with the application itself. And you're required to hang on to those if SBA has questions after the fact. So it makes sense to go ahead and do all the legwork now and just be as prepared as possible, because you're going to have to put it all together, and it's going to be a mountain to climb if you wait until it's all over to compile all this stuff. So
absolutely.
And also the other benefit, kind of piggybacking on what you've said, Jackie, is the sooner you start to tackle it, the sooner you're going to see what the nuances are to your particular situation. So you may say, ooh, I have a question 2 weeks in, rather than saying at the end of the 8 weeks, ooh, how was I supposed to handle that? And then having to untangle the web for the whole time. If you can kind of reposition and rechart the course as you're going, those corrections will be easier to identify and overcome any challenges that you might be presented with based on the particulars of your circumstances. So,
right, and we're going to get into this in a little more detail, but I feel like when it comes to especially the wage reductions and the reductions of full-time equivalent employees, you really have to play with the numbers to see how that's take out and affect your business and ultimately affect the forgiveness. So if you have any reductions currently and you're trying to weigh whether or not you want to keep the reductions or restore these employees, replace them, or even restore the wages that you may have reduced, you should play with those calculations now and the loan forgiveness application to see how it's going to fare at the end of the 8-week covered period. So, but we will get into that in more detail. So this is essentially what we're going to cover today. We have payroll forgiveness costs, some clarification regarding furloughed employee compensation and bonuses. There are loan forgiveness caps for owner employees and self-employed individuals, which we kind of touched on last week, but we were still uncertain exactly whether or not this was a new rule. The forgivable non-payroll costs, calculation of full-time employees, reduction in full-time employees, reduction in salaries, and there's certain exemptions that we also want to circle back on. Some have been in place for some time. Others just came out with the new regulations that were issued on Friday. And then lastly, I'm going to touch on just some additional guidance that was issued with the regulations on Friday that confirms that SBA is going to be taking a pretty close look at certain loan applications as they see fit. No one is exempt from that, and everybody needs to be aware of what they can look at and for how long. So we'll start with the payroll cost that can be forgiven. In the application, when it was released, there was an alternative payroll covered period that was provided, and the regulations that were released on Friday reaffirmed this alternative payroll covered period. So if you have payroll that occurs on a biweekly or more frequent basis, you have two options that you can select for tracking your payroll costs. The first is your general covered period, which starts on the date of disbursement of the loan and extends 8 weeks from there. And the second is the first day of the first payroll cycle that falls within the covered period. So for example, if you get your loan funded on a Wednesday and you're in the middle of a payroll cycle and your next payroll cycle begins the following Monday, you can move the alternative payroll covered period to begin that Monday on an even date with your next payroll cycle for administrative ease. Payroll costs are going to be considered paid on the day that paychecks are given or automatic deposits are received in the employee's account. And the regulations also reaffirm the fact that originally under the CARES Act, there was a standard that payroll costs and non-payroll costs would have to be both paid and incurred within the covered period. This has been clarified to not be the case. They either need to be paid or incurred during the covered period. If they're incurred during the covered period but not paid, you just need to make sure that you make those payments on the next regular scheduled payroll date. Also, if you have furloughed employees or those who are unable to work, but you're still paying them, their payments are going to be deemed incurred on the day that they would have worked. So you just kind of follow the same schedule that would be in place if they were in fact working. There's a couple of good examples that we provide in the slides that I've taken directly from the regulations, because I feel for once that they actually did provide some good examples.
Once it wasn't a big circular reference.
Exactly. So this is a good example of how we have a loan that funds in the middle of a payroll period, and the borrower can elect to use the alternative payroll period that begins on the first day of their next payroll cycle. They receive forgiveness for the payments that occur within the covered period, and also for the payroll costs that accrue during that alternative covered period. And Marina, I think you were going to touch on some
and before we move on to that, so Jackie, let's talk for a minute about people who are not on the biweekly or more frequent payroll cycles. So let's say we have people that are paying quarterly or paying their payroll monthly. They don't have an option, from the way we understand it, on choosing this alternative covered payroll period and really look at when their payroll period begins. So it's not going to be the end of the month. So from our understanding, I think they need to just prorate the payroll that they would have paid over that period for the 56 days or 8 weeks of the loan period. That's how we understand it. So if you're planning on paying, $20,000 in that quarter, if your 8-week period falls in that quarter, you just have to prorate that quarterly payroll for the 56 days inside your loan period. Is that how you understand it as well, Jackie?
Yes. The regulations, for whatever, I know that the loan forgiveness application has that limitation about the alternative payroll covered period only being available to those employers who have biweekly or more frequent payroll. That wasn't stated in the regulations that were released on Friday, but I think this is just a slip up, and one hand wasn't talking to the other. I think that borrowers are still going to have to follow those instructions, and yes, that's how I would interpret the quarterly or monthly payroll. It's definitely
good for convenience purposes when you are running payroll weekly or bi-weekly, where it's going to be really hard for you to really calculate the proration of your payroll for the 3 days before or 3 days after. So this is really to make it administratively more simple. And I think that those employers that have monthly or quarterly payroll, it's going to be, most of those from our experience, is going to be your owner employee that's on payroll, maybe another person or two. It's going to be easy enough to take the monthly or the quarterly payroll and prorate it for the 8 weeks of the loan. So I think that they don't need necessarily as much of the administrative relief as the ones with biweekly payrolls. So let me touch on a little bit on the furloughed employees. So the key here, how we understand it, is that you cannot prepay payroll. Okay, so you cannot pay people ahead of time to say, oh, I got PPP money and I know you're going to get furloughed after PPP is over, so I'm going to pay you now to prepay for future. You cannot do that. But if you haven't paid your people, if they've been furloughed and you're bringing them back, you can definitely pay them during the payroll period that falls in your 8-week loan cycle. You can pay the back pay. As long as, again, the back pay does not get them in excess of 100,000 annual salary, which prorated for 8 weeks is the 15,385 number. Okay, so you cannot catch them up and get them up to over 100,000 annual or 15,385 for the 8 weeks. And that goes for bonuses. Again, you can, if they were due a bonus, or you want to bonus them because maybe they've done really well coming back and really have taken on some extra responsibilities, and you want to bonus them, that's definitely a part of normal payroll. You just cannot bonus them ahead of time for something that they will do, because again, remember, there's going to be no prepayment of the cost. So I think that's where that rule comes in. I think that's all I wanted to mention on bringing people back in their salary. This next one is quite an interesting one because we really didn't see it coming until the application instructions and the SBA guidance was released last week. So the kicker here is owner-employee. That's the one that really got me. So we always knew there was 100,000 cap on any employee, including if you're an owner employee or if you're a partner or if you are a self-employed individual. So you're capped at 100,000 for your payroll for purposes of applying for the loan and getting forgiveness. What the instructions to the application and the SBA guidance said is when you're looking at the owner payroll, the amount that is used for forgiveness is capped at 100,000 max or last year's compensation level, whichever is less. So if the owner employee took a small payroll in 2019, like $30,000 W-2 for the owner, they're going to be capped at the $30,000 for their salary in calculating the forgiven amount. That is completely brand new and kind of goes against some of the planning advice that we've been talking about and we've heard from other practitioners and we've read about, where we said, listen, if you have to cut some of your employees, you can get your salary up higher as long as you don't go over 100,000 your annual compensation. Give yourself a raise. You know, as a partner, you can take more and guaranteed payments and so on. But this is telling us that we really need to look at your W-2 as the S-Corp shareholder for last year, which is really a big surprise. So I want to highlight that point again, because a lot of our clients have mentioned that, oh, you know, my assistant may be furloughed or maybe I'm not going to bring them back to the same level or something like that. I'll give myself a raise. Or maybe people have gotten PPP funds that were calculated inconsistently or wrong, and the amount of the loan was higher than anticipated, and people said, no worries, I'll give everybody a raise, including myself as the owner, and I'll eat up that PPP loan. Well, you as the owner, your compensation is going to be capped at last year's. What we always knew is for the self-employed individuals that applied with Schedule C, the amount of compensation used there was always 100,000 max or the net income on line 31 of their Schedule C, and that is the same number that's going to be used for forgiveness. So I think they, the only thing I can think of why this now works is they put the shareholder, employees, and partners with guaranteed payments on the same footing as the self-employed individuals on Schedule C, and said, look, if we're gonna use 2019 compensation levels for all of the owners involved in a business, it's going to be across the board. That's the only reasoning I see behind it. So as a planning point, and we've been thinking about that, and Jackie and I have talked about this, and I've chatted with some of my clients already this week after knowing about this. If your spouse is on payroll, or your kids are on payroll, there's no limit for what your spouse or your kids can make. So if you do need to make up some payroll and you do need to hire somebody, you may hire an outside person, but if your spouse, let's say, is already on payroll, you can increase their salary. You just can't increase your own. So that's also is a bit of a funky thing, but that does work around those rules a little bit. So that we want, I'm sure we're going to be coming back to this point because it's a critical point. And they kind of snuck it in the instructions to the line item, which is really funky. When you go through the application, they actually take out the owner compensation from the general salary line and say, don't include the owners on this line, include the owners on this line. And for the line where you have to include the owner compensation, that's where they throw in the instruction for the 2019 limit. So we were both, Jackie and I were with Jackie with a magnifying glass and me screaming on the phone. We're just surprised at that. So
there you go. The devil's in the details once again.
The devil is in the details. Yes, absolutely. Absolutely. The general partnership works the same way. As we mentioned, I think last week's webinar, the SBA guidance said you can use your K-1 income for your compensation. It's going to be the K-1 income that is subject to payroll tax, which is why you have the items as in, it's going to be your line 1 from your K1, less section 179 deduction, less some of the other deductions. It's basically going to be the number that's going to get you to, if you're technical, it's line 14 on your K1 schedule for a partner, and that's the line that shows how much of your income is subject to self-employment tax as a partner. So that's going to be the amount that really can be used as the max for the compensation. And again, we're looking at basically 2019 K1 amount, nothing that is really based on this year as the max. Health insurance, if you're health insurance, if you're self-employed, or even if you are a company but you don't have a group plan, anything that you pay out of pocket for health insurance is not part of the payroll cost that's eligible for forgiveness. It's deductible for tax purposes, but it is not eligible for the, but it's not part of the payroll cost for the forgiveness purposes.
Perfect.
Yeah.
All right, but it is going to be eligible for those owner employees. So if I'm an owner and I'm issued a W-2, I can include what my company has paid to me as
Exactly.
For retirement and health insurance.
Correct. If you as the owner are on group plan, then absolutely. Then you as the company, whatever you contribute to the group plan, that's definitely part of the costs that are part of the forgiveness.
Right. All right. Do you have anything else to add on to that before we go on?
The only thing I want to say is there was one question that came up just for the benefit of the group that said there was some confusion with respect to the alternate payroll period. And someone asked, if you are using the alternate payroll period, can you count the 8 weeks plus the previous week because the check date will fall within the alternate payroll period, essentially making it 9 weeks? The answer is no. You are only getting 8 weeks. All it's doing is allowing you to adjust the needle to line up the start date of your 8-week period with the start date of the payroll period. So that way they run together. So instead of having payroll drop on one day and your period start on the day of the loan and then having to recalculate, you're still only going to get the same 8 weeks, just you're moving the needle on the start date. Like your loan paid on a different day, basically.
Mm-hmm.
And you might have some payroll costs that accrue or are incurred towards the end, the tail end of your covered period, and you will still get credit for that for forgiveness purposes, even if it's paid after the covered period expires. But it just needs to be paid timely in accordance with the normal payroll schedule. So forgivable non-payroll costs. I also want to just mention that we aren't really getting into details about what are forgivable payroll costs and what are forgivable non-payroll costs. That's because I did put together that chart that I promised last week, which is going to be released along with the slides at the end of today. So I think,
everyone else get your magnifying glass out and be ready.
Yes.
Well, I do. There are some very fine distinctions between, especially now with the owner compensation and the new rules that have just come out in that regard. We have a chart that compares what are payroll costs as they refer to and the rules and as we refer to in all these webinars, what are those payroll costs? We have a chart that compares them side by side for various kinds of entities, whether you're a partnership, a corporation, or a Schedule C filer. And then we also compare what are forgivable expenses versus permitted uses of the loan proceeds, because again, everybody seems to gloss over the restrictions against what you can do with these loan proceeds. And I've even heard practitioners out there saying that after a certain point, you can use the loan proceeds for pretty much whatever you want on a boat, which I completely disagree with. So we'll get to that later. But I just wanted to make mention, if you're watching this and saying, okay, well, you're not really defining what payroll and non-payroll costs are, we will be sending you something that you can refer to later to answer those questions. Mm-hmm. So for forgivable non-payroll costs, which are generally mortgage interest, rent, and utilities, which are subject to agreements dated before February 15th, these are eligible for forgiveness as long as they are paid or incurred during the covered period. So this is similar to the payroll costs. What's different is the non-payroll costs have to be measured during the primary covered period, which begins when you receive your loan proceeds. There's no alternative covered period that's offered for the non-payroll costs. So if you do elect to do the alternative payroll covered period, you're going to have to track these kind of separately. Now, what's nice about this is the regulations that were issued on Friday clarify that in certain circumstances, depending on when you receive your loan proceeds, you may actually be able to recoup forgiveness for more than 2 months worth of these non-payroll costs. And an example they offer is a borrower's covered period begins on June 1st, and they're able to pay their May and June electricity bill during the covered period. And they actually accrue some of their electricity bill for a portion of July on the tail end of that covered period. So they're actually able to recoup forgiveness for both the May and June payments and the prorated portion of their July utility bill that fell on the tail end of that covered period. And the rationale for this is basically, since we're capping the forgivable non-payroll costs at 1/3 of the total forgivable payroll costs, nobody's going to get a windfall from this like little scapegoat that borrowers might be able to enjoy. So you may be able to collect more than 2 months worth of forgiveness for these non-payroll costs. You don't have to cap yourself at that. You can go ahead and enjoy that because you can't really take to, nobody's going to get a windfall from this essentially. So.
This is another section that also is, it's good in that it clarifies really what is a full-time employee. We've gotten this question quite a bit, how many hours, and this clarifies the fact that a full-time employee is considered an employee that works 40 hours in a week. So I know we have gotten questions from clients, was it 32, is it 30, is it 35? It is considered 40 hours now. I am not sure, and I think that maybe is a good question for our labor attorney is it 40 hours including, just your standard, but including the lunches and the breaks, or, I'm assuming that that is the case. So if we're looking at just a regular full-time person, if their work week is 40 hours, that does include not necessarily working 40 hours, but that will include all of the lunch and the breaks that needed to be taken. So let's go with the 40 hours, and maybe we'll also get some clarification on that a little bit later. But the key here is what to do for those that are part-time. So we, this is also kind of a little bit of a riddle to wrap your head around, but the idea, they're offering you kind of a simple way of looking at it. And they're saying, look, if you've got a 40-hour-a-week person, you put them as one for one full-time equivalent. If anybody works less than 40 hours a week, you put them as half. So essentially anybody who's a part-timer is half. So you either have 1 or 0.5. Or alternatively, what you can do is if you actually calculate their hours. So if somebody works, in this example, if you have a person who worked 10 hours a week, you take 10 hours out of 40 hours, and that's a quarter, and you round it up so it's 0.25. And that, I think, may help you in the case of where you have part-time people that are maybe just slightly under 40 hours a week. So instead of counting them as half, they will be maybe 0.8 or 0.75. And if they were like that before, it's really for the purposes to see how many full-time equivalent you had during the base period for which you applied, to see if you reduced anybody. So I think the key here is really to keep track of the hours. And because we have a choice of how to calculate the part-timers, I think we got to do it at the time when we fill out this application. Instead of choosing now how you're going to treat them, it's going to be, let's calculate them for the actual hours that they worked and see if doing the roundup of the actual calculation of number of hours they worked over 40 is going to be beneficial, or taking the simplified method and just treating anybody who's part-time as a half. That may just work as well. So again, the key is keep track of all the hours that your people worked. So then we can, we can get into that. So I think that's just something for you guys to, keep in mind as you're tracking everybody's hours. And, the reason for that is the next section, which Jackie is going to start out, which is figuring out if you reduced any of your full-time equivalent people.
Right. So if we have a borrower who has had employees at full-time equivalency, and then they drastically reduced their hours, so they have like 5 or 10 or 15 hours a week, they would probably benefit more from this second approach, which would be to assign the 0.5 to each employee. Whereas if you only reduce their hours by, say, 10 and they're working 30 hours, I think that first approach could possibly behoove you more. So again, you have to kind of play with the numbers and see what's going to benefit you most, so you can decide whether you want to increase the hours or keep them where they are, because really it might not make that big of a difference in your forgiveness.
Absolutely.
So we wanted to kind of start by explaining how you can calculate your full-time employee headcount. And then we're going to go into the reduction. If you have a reduction of full-time equivalent employees, in general, if there's a reduction, it's going to reduce your forgiveness by an equal percentage. So if you reduce your full-time employee headcount by 20%, your total eligible forgiveness for both payroll and non-payroll costs is also going to be reduced by 20%. And after selecting sort of, I guess, before you select the manner and how you calculate the number of full-time employees, you can take a look, or do at the same time, look at the different selection periods, because that can also make a big difference. So borrowers have a choice between either the period between February 15th and June 30th of 2019, January 1st of 2020 through February 29th of 2020, or if you're a seasonal employer, you can elect either of those periods or any consecutive 12-week period between May 1st and September 15th of 2019. So after you do that, and after you determine your full-time employee headcount and calculation method, and whichever one is going to benefit you the most, if you do in fact have a reduction in your full-time employee headcount, you're going to incur that reduction in your forgiveness. For example, if a borrower had 10 full-time employees during the reference period and this declined to 8 full-time employees during the covered period, the percentage reduction is 20%, and only 80% of your otherwise eligible expenses are going to be available for forgiveness. Is that consistent with what you understand, Marina?
Yeah, so when we go back to that other calculation of, using the formula to calculate how many full-time equivalents do we have, do we just add all our FTE equivalent, all the FTEs along and say, well, we had 8 because we had 0.75, and then we had 1, and then we had 0.5 and 0.2 to get to that total number, right? That's how we're understanding it.
So you're going to take basically the aggregate of those individual quotients you do for each employee. So you take, I'm an employee, I'm working 30 hours a week, you divide that by 40 and you get 0.75. The next employee is working a solid 40 hours a week, they get a 0.1. The next employee is a workhorse, they're working 80 hours a week, you're still capped at 1. You take the aggregate of those amounts, and that's how you get to your employee, your head count. And you have to apply the same calculation method to both the reference period as well as the covered period. You can't play with those, and you have to also apply consistently in a similar manner to each employee as well.
I also wanted to add that when you look at that application, one of the first lines on the application is number of full-time equivalents you had at the time of loan application. So at the time when you applied for PPP loan, and then how many FT equivalents you had at the time of loan or at the end of the loan. Well, what I wanted to hit for the actual calculation of whether you had FTE reduction or not. So it may be the same number. So maybe the base period that you used, which was that period in 19 or that period in the 20, is going to give you the same employees as you had at the time of application. But the key here is those 2 lines at the very beginning of application that say how many people you had at the beginning of application versus at the end, that may just be for the bank or the SBA to tell them, should we look at that schedule more closely if that number changed? But that's to tell you that that is not going to be the number that's used for the reduction calculation. It's really going to be based on the base period, which Jackie just went through on what your choices are.
Perfect. All right, Marina, do you want to talk about a reduction in salary or wages?
Yeah, so here, this is also, I mean, all of them are just, everything is very, very detailed, guys. But back into, so a couple of things here. Let's first look at the base period. So back to the alphabet soup of the different dates. When we're looking at 25% reduction in wage, 25% of what? It's going to be of the first quarter payroll, which is January 1st to March 31st. This, please note that this is a different base time frame that you're using to calculate the reduction in the full-time equivalents. So again, the base for the reduction in payroll is different than the base period for reduction in the actual number of employees. That is very critical to understand. This is yet another date that I don't think this date was around in the early regs or any of the material. This also came out as part of the application instruction. So when we're looking at that schedule that talks about the reduction, it says, look at these employee wages in really the first quarter. It's January 1st to March 31st. And then look at whether you had in excess of 25% reduction. So the date is the first thing that I wanted to highlight. The next thing that I wanted to highlight is the following. A lot of people have asked us, well, if I reduce that employee's wage by more than 25%, does that mean I get dinged for the whole reduction? And the answer is no. When you go through the calculation, the amount of your reduction of the forgiveness is the excess over 25% of the salary reduction. So if you reduced somebody's salary by 30%, your forgiveness reduction is only the 5%. So let's say somebody was getting paid $100,000, you can't reduce their pay by down to less than $75,000. You reduce them down to 70. The reduction amount in your case under this formula is only going to be the 5,000. You still have to keep in mind that your overall payroll that you spent is down. So now you got to look at where, again, are you going to make up? Back to my example of giving yourself a raise or a family or hiring a new employee or doing something else. So you still have to be mindful that your overall payroll cost is going to be down if you reduce these people. But the actual amount of forgiveness reduction is only what is in excess of 25% salary reduction. It's very algebraic.
So Marina, what if we have a reduction in the full-time equivalency headcount, and I've reduced some of my employees' hours, which thereby also technically reduces the compensation that they would normally receive? Am I going to get dinged twice for that?
You're not getting dinged twice, no. But you have to go through two different calculations here. So you are looking at the salary reduction for this person, and you are looking at the FTE reduction as well. So if you have somebody who now went to, let's say, less hours, but maybe you did not reduce their salary by more than 25%, you're not going to get dinged here. But you may get dinged because now, instead of them being 1 for a full-time equivalent, there are maybe now only 0.7.
Right, but only if I reduce their hours and reduce their wages, am I going to get dinged twice for that?
Correct, absolutely right. Yep.
Perfect.
We have a question on the rounding of full-time equivalents. Angela's asked, so how do you round up or down the full-time equivalents? And what if you have an average 3.7 FTEs during your reference period and 3.4 during the 8 weeks period?
That, to me, that sounds like a reduction of 0.3, because the way that I understand it from the application instruction is you're rounding to the nearest 10th.
Okay.
Jackie, is that your understanding as well?
Yes, absolutely.
This is where you would play around and say, will it be better for me just to use the 0.5 for anybody who's a part-timer?
Yeah, and to play around with the periods, the reference periods that you can use. I think you have to play with both of those and just see how the numbers shake out. And practitioners continue to say that when you really don't know until you get into the application and play with those numbers. You can't, I wouldn't just roll the dice on that or guesstimate. I would actually run the numbers and see what's going to serve you best.
Absolutely. If you had any change in employees or their hours, I would definitely look at the both base periods that are allowed for that calculation. And the other thing is if you're seasonal, and Jackie touched on that a little bit, but if you're seasonal, that throws a whole new wrench in the equation, because you have a third choice for the base periods of your full-time equivalents, which is any 12-week period in a specific time frame in 2019. So you have even more opportunity to play around with what is better for you to see if you've reduced anybody or not.
Perfect.
And the other thing before we move on to that, back to the seasonal stuff, I want to mention is that 12-week period that you can choose, that really is not seasonal so much for Florida people. That's seasonal more for businesses that ramp up in the summer, which for us, it's the other way. Because I believe that 12-week period falls anywhere from May to September. So, you know, if you were up in the summer, I mean, it may work for you if you were down as well, but I think that that's meant for more your traditional seasonal business that may ramp up during vacation time. And for us, it's kind of the other side of the equation. But anybody who's seasonal, like the restaurant businesses, I would certainly take advantage and look at, because if, let's say, you had to furlough your people now, and you're looking at last year, that 12-week period in the summer, and we have the dates for you, it's, you know, from May to September, that's where you probably had less people as well. So this may really work for you to make sure that you didn't have the FTE reductions.
Perfect.
Mm-hmm.
So we wanted to circle back and touch on some safe harbors that have been in place, and there's certain exemptions and exceptions to the reductions that were affirmed by the most recent regulations that were issued on Friday. So first, this safe harbor has been in place basically since the implementation of the act itself, but I just want to reiterate this. If a borrower eliminated or reduced employees or salary or wages between the dates of February 15th and April 26th, and then restores those employees or restores those wages by June 30th, you won't get dinged for the reduction in your forgiveness. Now, Marina and I have lamented about this random safe harbor period between February 15th and April 26th. Technically speaking, the way it provides, if you reduced your employees on February 14th or on April 27th, you don't fall within the safe harbor. I'm hoping that they'll issue additional guidance that loosens this a little bit. It doesn't really make a lot of sense to me, but that currently is where the law stands. Something new that came down with the regulations, and which was also included in the loan forgiveness application, is if you have an employee who was fired for cause, that voluntarily resigns, or that requests a reduced schedule because perhaps they are at home with their kids and they can't work as much, so they've actually requested the reduced working hours, you will not be dinged for that as well in terms of your forgiveness. Now, what you need to make sure you do, and the regulations were very clear about the fact that they're not going to give you a whole list of very specific documentation requirements, but they do generally state that you need to document this, and I'm sure your employment attorney would agree. If you terminate someone, you need to have some kind of letter confirming the date of the termination and the basis for the termination. If somebody resigns, if they haven't given you a formal resignation letter, just request that they put that into an email so that you have it for your file. And the same thing for the schedule reduction. You just want to make sure that you have these in your file for future reference, because SBA is entitled to come back and request confirmation of these items, and you're also required to keep all documentation required by the forgiveness application for 6 years. So make sure you get these items and keep them in your file for future use.
Mm-hmm.
Now,
and the application and instructions also say that if you do end up replacing that person anyway, you don't even have to worry about it. You don't have to
right.
Include that person in and say that, yes, I did not lose any of my FTEs. It's still at a 1. If you replace them, it's a wash. But again, it's very important to understand that safe harbor period to bring people back by June 30th, that does not apply to this exception where if somebody quits or resigns or fired for cause, you don't have that same time frame that you need to replace that person. That person, you don't get dinged for that person. If you happen to replace them, that's great, but you don't get penalized.
Right. And this is another exemption that was actually confirmed first in the SBA FAQs, and it was formally implemented through this recent regulation that was issued on Friday. It also is not subject to that safe harbor period of February 15th through April 26th. But the regulations actually gave it a little more teeth and some more specific requirements. So if you have a borrower who reduced some of their full-time employee headcount, and they offered to bring those employees back, and the employees declined, in order to enjoy this exemption, you need to make sure that you meet all of these requirements. And this was not previously what was required under the FAQs, but again, the regulations implemented these additional requirements. So you need to make sure that you made a written offer to rehire the employee during the covered period or alternative covered period for the same salary or wages for the same hours. You need to have documentation that the offer was rejected. You need to maintain that documentation. And more importantly, you're required to inform the unemployment office of this rejection of the offer within 30 days so that that employee can enjoy unemployment benefits offered by the state and the federal government. So if we have any borrowers out there who, for instance, maybe offered to bring back an employee more than 30 days ago, I think what you can do here, I don't see anything that would restrict you from offering a second time to bring this employee back. And if they again reject the offer, just make sure you comply with all these requirements, and then you can enjoy this exemption. But like Marina mentioned before, if you've replaced that employee, it really makes no difference because now you don't have an issue with your full-time employee headcount. Do you guys have anything to add there before I move on? All right. So I wanted to also, sorry, Marina, were you going to say something?
No, I think that's great. And I just wanted to touch on the fact that that rule did come out of probably, you know, the actual reality of people trying to bring some of the employees back, and the employees were by then receiving unemployment and said, oh, we're making as much or more money on unemployment, so we have no interest, come back. I think that really was put in place to say, no, if you're offered your job back, even if it's a part-time level, you got to take it. We don't want you in the unemployment world.
Right, right.
Now, can you though touch on if you do lose somebody and you aren't sure if you want to hire somebody, would that be an opportunity to maybe hire a family member?
I think so.
Yeah, I think so too. Absolutely. Mm-hmm.
I don't see any reason why not, especially if
mad
you're
when they get the boot in 8 weeks.
Well, and I think that the key here is, again, reasonability. So if you're hiring a family member, don't just hire them to put them on payroll, you know, and this is where the labor attorney is going to roll her eyes. You really are hiring them to do some stuff. So if you have somebody who left, or you really do need help, and maybe you do need help just for this period because you're not ready to bring some of the people back because you're still not doing well and you're not going to do well after the 8 weeks of loan is over, bring your family member in and have them help you. Actually have them have duties and responsibilities and work. Don't just bring them back just to throw them on payroll. I would definitely keep track of what it is that they've done and that you've paid them a reasonable amount, because at the end of the day, you still have you still have an expense, or you still have an amount that you paid that if you ever are audited for this, you need to support the fact that it was reasonable payroll. So
exactly.
There's planning, but then there's, you know, you got to stay. It's an area you kind of have to stay there.
Perfect. So something else, lastly, that I wanted to touch on is there were 2 sets of regulations that were issued on Friday. One was giving us more clarification on the forgiveness application and the forgiveness requirements that we've been going through in the last hour. The second set of regulations was really giving lenders and borrowers guidance on what SBA is going to do in terms of their review. And they very clearly stated that they're going to be reviewing as they see fit eligibility, the use of proceeds, and also the forgiveness. And they can actually go back to your loan application and the documentation that you submitted with the loan application to determine if they truly felt that you were eligible for this loan. They also very clearly state that they want to make sure that you save all the documentation for 6 years. I would include your original loan application, anything that was supplied with the loan application, as well as everything that is required by the forgiveness application, because they can technically question you on all of that. So in case they come back 5.5 years later, which would be very annoying and unfortunate, if they do that, you have the documentation to substantiate the figures that you provided. And they also confirm that they can request additional documentation at any time. So the reason why I'm bringing this up, and I have mentioned this before casually, and I just want to reiterate it, that there are regulations out there that have very clearly outlined what certifications have to be included in these PPP loan applications. There's a handful of those, but I'm only going to touch on a couple here that I think are noteworthy for today's discussion. One is the necessity certification that there's been so much discussion about, which is current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. Now, everybody has been a little confused because of that safe harbor rule that was released, which actually hasn't been formally implemented into a regulation. It's still just an SBA FAQ, but it talks about the fact that if you fall below 2 million, if your loan falls below 2 million, that you will be deemed to have made that necessity certification in good faith. However, as Marina has mentioned before, that doesn't mean that you're now exempt or immune from any other kind of action that may be brought by another governmental agency. So there's ways for SBA or the Department of Justice to come upon information about the fact that maybe your business is doing better than ever, or the revenue is not down. If your revenue is not down, or if it's up, and you don't have any reasonable basis to anticipate that it will go down, you need to strongly consider whether or not you can actually make this certification in good faith. Another item I want to touch on is the fact that there are very, very specific permitted purposes for these payroll protection loan proceeds, and they're clearly outlined in this regulation that was issued back on April 15th. And they also very clearly state that at least 75% of these proceeds have to be used on those permitted payroll costs. And a lot of people, I feel like, are glossing over that requirement. So you need to keep that in mind, that at the end of the day, you need to make sure your loan proceeds are used at least 75% for the payroll costs, with the balance, or more, with the balance being used for the permitted non-payroll costs. And the certification that I'm pointing to states that the funds will be used to retain workers and maintain payroll or make mortgage interest payments, lease payments, and utility payments. I understand that if the funds are knowingly used for unauthorized purposes, the federal government may hold me legally liable, such as for charges of fraud. So I'm saying this because I feel like it's not being touched on too much by other practitioners, but people need to keep that in mind. So.
Jackie in the magnifying glass. Everybody going to jail.
Hopefully not, but you know, everybody, the devil is in the details, and a lot of people are glossing over what I think are pretty critical details. So
what I would like to start covering next time for sure, and we didn't get into it this time, is exactly what documentation you will need to submit with the loan forgiveness application versus what you need to keep for your records. I can tell you anything that you have, you're going to have to keep for 6 years, but we will just look a little bit further on. There's some instructions, and I think there's also some guidance on it. As we get into more of the specifics of the application, I will definitely bring you guys some of that. But at this point, again, keep everything, have all the backup documentation, because if it's something you don't have to submit, that's great, but plan on having to submit majority of it.
Couple questions here before we run. We have just a couple of minutes. If anybody else has more questions, you're welcome to dump them in the Q&A box, and we'll do what we can. We can't address anything too specific, just for the benefit of the group, but we will get what we can. Leslie's asking, what if the owner's is not 50-50 but 60-40? Can you use a different percentage for the owner's 2019 wages for the PPP loan forgiveness value?
I don't think so.
I don't think so. I think it's whatever their compensation was.
Okay. Perfect. Can a self-employed person print a bank transfer confirmation from the business to personal account, or must they physically write a check?
I don't believe any money has to actually be moved if you're self-employed and from Schedule C. There has been absolutely nothing to say that you need to show that any money was actually spent or moved. It's really going to be just based on your net income from your Schedule C of 2019. So you don't actually need to spend that money or move them or, you know, do anything else. That from what we understand. Jackie?
I think I think we have to keep in mind that there's certain single member LLCs, which are Schedule C filers.
Mm-hmm.
So if you have a separate bank account, if you're a single member LLC and you have a separate bank account, business bank account, I think maybe in that instance,
Mm-hmm.
you could move your 2019, 8 weeks worth of your 2019 compensation into your personal account. But Marina, would you agree that you should probably do that consistent with how you may have previously paid yourself in 2019 and through 2020 as well?
Absolutely. Yeah, I would keep that consistent. If that's what you did last year, I would definitely do this year. But if you're just a self-employed guy, you don't even have a separate bank account, you're just on one account, don't worry about actually taking that money out physically.
Okay. Last question. A self-employed person, your loan came in, for example, at $10,000 as your 2.5 months of payroll. Is only $7,500 of that forgivable based on the loan amount? Is that what they're saying? Can you talk a little bit about the self-employed debt forgiveness?
So, yes, if you used 2019 Schedule C net income from line 31 to calculate the loan amount, you shouldn't have a problem getting that whole thing forgiven because that's going to be the same amount that is used for forgiveness.
Perfect. All right. Thank you so much, ladies, for once again, the deep dive down into the dark tunnel of PPP.
It's the beginning. It is the beginning.
It really is.
Absolutely the beginning.
It really is. We will continue to bring you more information on this. We will also, at the point that we're able, once we have enough guidance, we will handle we'll be doing not only an evaluation of the debt forgiveness, we'll be going through the loan application with you. Several people asked about where can I find the loan forgiveness application. I've put that in the Q&A and also into the chat. That'll be distributed with our materials as well. You can also Google SBA loan forgiveness, PPP loan forgiveness application, and you'll go right to it. When you read it, I promise you will have crossed eyes. All three of us have read it a multitude of times, and it's still not much better. We'll be addressing the loan forgiveness, and we will likely, in the next 2 weeks or so, be doing another webinar on the loan forgiveness specifically for Schedule C independent contractors, our realtor friends specifically. So stay tuned. We'll continue to hit this stuff up. It's Thursday. We will see you next Tuesday.
Thank you, guys.
If you guys have any questions, let us know. Have a great week.